On the podcast with us today is Mark Kenney. Mark, welcome to this podcast.
Thanks for having me, Dan. I appreciate it.
Well, Mark, I want you to get us started. And first, before we dive into this property that we're going to be diving into today called Country View, it's a 321 unit property in Memphis, Tennessee. We're going to dive deep into that and get to some of the details. But I want you to just get us started and talk to us a little bit about you and your background before we get started.
Sure. Yeah, so I grew up in Michigan. I'm in Dallas now. I went to college like normal, everyone else, went for accounting, but also started looking at real estate when I was a senior in college just because I knew it was something everyone needed. You know, people need a place to live. So I was 22 years old, got my first property, and started buying small multifamily. And then was a CPA for a while, did IT consulting, continued to buy, and then had my own IT company in 2008. Had projects pretty much all over the world, which caused a lot of problems because I would work about 85 hours a week, sleep about 3 hours a night, which I don't recommend to anybody, but it caused a lot of problems, frankly, family wise. So we decided, my wife Tamil decided I needed to do something a little different. So I ended up buying 2013, started buying larger multifamily properties and started getting into syndication. And that's now I do full time. I don't do anything else other than buy and then have an educational group.
Sure. Well, this property that we're going to dive into today is called Country View. It's got 321 doors, located in Memphis, Tennessee. Do you have any of the high-level specifics available, like the projected returns and things like that?
Yeah, I'm going back a little bit here too, but it was a property that was in a 78% occupied, so it needed work. Now, it wasn't that the property was in distress or anything. That was a good thing. It was the original builder who built it. So I think it's 84 construction. He built it, he ran it, operated it. But from a management perspective, there were some things like you couldn't pay your rent in the office for 321 doors. You couldn't. They had no computer in the office. So there were things like that when you're kind of, they actually thankful when you go there and go, my goodness, these guys are pretty messed up.
So they didn't have any computers in the property management office. How many people are on site?
On site, they probably had, I'm guessing, 8 for 321 doors.
Is that typical for a 321?
Yeah. I mean, in 100 units, you're going to have, 2 plus. Yeah. So it depends how old it is, things like that. So I think they had probably close to 8 total. But they had units that literally could have been turned for, made ready for, $1,500 just sitting there for just not getting done.
Wow.
I think it's, I think he had it paid off and probably really wasn't too concerned about it. So it had a big management play to it. Now, anytime you buy a property that's, in the 70, percent occupied, anything below 90%, you're going to run a little bit of issue with agencies like Fannie and Freddie. And so this particular deal, we ended up getting a bridge loan. We got good terms on it, got a bunch of financing. We had a pretty big budget. Rehab is $13,000 a door, so pretty big. But what that allowed us to do, Memphis has something called a pilot program. And the pilot program is you purchase a property, and if you put a significant amount of money, typically it's 50% of the purchase price. If you put that much in rehab into the property, then they'll cut your property taxes by 50%. And then they'll freeze them for 10 years.
Wow.
So cash flow is great.
So you plan on holding it for 10 years?
Well, it's transferable. We actually bought another property that already had 2 years into the pilot. We bought that property. People always ask how long you'll hold it. I don't know. It's been 13 months so far, and literally we're doing a refinance. We're going to pull out over 100% of all the capital.
Wow, that is awesome. Well, let's step back a little bit and talk a little bit about how you found the deal. Because, I know you've been in the space a little bit longer than a lot of other people we've had and interviewed, but how did you actually find this particular project?
We had bought, I think prior to this, we had bought 3 or 4 properties in Memphis. And you get into some of the smaller markets like Memphis versus, let's say, a Dallas or, things like that. There's usually only a couple brokers in town that pretty much do
the main guys.
Yeah. So we had a good relationship, with some brokers there, two main ones, and they brought it to us. It was numbers looked really, really good on it, and we knew this is the way it was managed and such that we could bring the occupancy up. I mean, it would be pretty difficult not to manage it better than they were managing it, frankly. So that was a good thing, and the occupancy went up. After 4 months, it was like 95% occupied.
Wow. That, man, just doing that is phenomenal. What did you do when you first got the deal? Was it one that was mass marketed to, well, first let me ask you this, was it one that was mass marketed to everybody that was on their marketing list?
No.
Or was it one that just said, hey, I think Mark's group can handle this one?
There are other groups involved, I know that for sure, but it was pretty much lightly. It wasn't like a mass market like a lot of the other deals.
Mm-hmm.
Which doesn't mean in general people think, well, I get off market, or it may be you get a steal of a deal. You can get typically better deals, but in the market today, you're not typically getting steals, steal of a deal. You're just not.
Yeah.
But less competition. People aren't there bidding and jacking the price up like some of the markets, like, Dallas, for where I'm at right now. A lot of people bidding on them to jack prices up.
Yeah. What was the cap rate that one was purchased at?
The cap rate was, I'm trying to think exactly what it was. It was a little bit lower because the NOI was so low.
Yeah.
70, it was, extra. So I don't remember. It was probably like 5.
Yeah.
So low. But
that's low for Memphis for sure. But when you're at 78% occupancy, there's definitely some more room for growth there.
Right. And to be able to pull all the money out in literally, 13 months is
what was the debt service coverage ratio on that one? Was it above or below 1?
It was a little over 1.
Okay. So
we got our bridge loan. I mean, some people might not know, necessarily what that is either, but the agencies, Fannie and Freddie, typically want to be 1.25 or above, where your NOI is 1.25 above your debt service. Now, with a bridge loan, there are some, if you've never done one before, there can be some complications. Now, you've done one before.
Mm-hmm.
The first ones you do, you learn a couple of things, like, hey, I don't know why, but their attorney fees are like 3 times as much as Fannie and Freddie, and they charge you more points in and out. They'll do some other things like a rate cap. So like what's a rate cap? They want to actually be able to control how high the interest rates can go up. And that can be, $50,000, $60,000 on some deals. So it's not necessarily a small number.
Yeah, I'm gonna say, what was the purchase on this one?
It was, we paid about 30 a door.
Okay.
And a little under 30 a door. And then we put 13, we had allocated 13 a door of rehab. We have not used all the rehab money yet. And frankly, it was because a lot of the units, we did some big things, roof, the parking lot, HVAC units. So some big ticket items. In some cases, some items that really wouldn't generate a lot more revenue necessarily, but they need to be done.
Just deferred maintenance.
Right. And they had, they also had a requirement for 4 times for rent. So 4 times earning for rent. And typically in that market, it's going to be 3 times. So they were turning away probably some qualified tenants as well. So it's almost one of those deals, and believe me, not all like this, where every single thing that could go right went right on it. And better than and faster than we anticipated.
Yeah. So what was the overall budget for renovations per door or overall? I know I just did the calculation. It was like 9.6 million purchase for that.
Yeah, and it was 13,000 a door for rehab.
Okay, so that's still pretty significant for 321. That's almost 4.2 million in renovations.
Yeah, the thing about it too, and that's one of the advantages. The disadvantage. One of the advantages to a bridge loan. We just did another deal in Memphis about 6 months ago, and we got 85% of the purchase price and 100% all the rehab dollars rolled in. And the rehab was literally equal to the purchase price on this property.
Wow.
So that's an advantage if you're kind of going that route.
Mm-hmm.
I mentioned some of the disadvantages, but there are some advantages to doing it as well. And typically a bridge lender will work off a pro forma. Fannie and Freddie, even if you were $500 below market on your rent, they don't care typically. They'll only underwrite at the most aggressive, the T1. Usually it's T3. So there's some differences.
That well, and obviously, there's this one definitely needed the bridge product on it because there wasn't really that much of an option with it. What was you had mentioned the tax abatement for like 50% and reducing 50% of your property taxes and locking that in for 10 years. And if you do 50% renovations, was that based on the non-land value?
For the renovation amount?
Yeah, because it seems like you weren't quite there at that 50% mark, or were you able to negotiate that?
Yeah, it's kind of an approximate. That's what they want you to do, and then there's other rules around it too. They want it to be like tenant improvements, so it'll vary. Now, the advantage you have sometimes is that if it's a property where the city simply just wants to get it done, they'd like you to rehab it. You have a little bit of negotiation there. And people are taking advantage of this, and it'll take time, but the areas in a lot of these cases are changing because people are doing that. That's a big rehab for properties.
Yeah. Would you say that most cities have some form of program like this, or is it kind of just hit or miss?
No, I hit or miss as far as I know. I don't really know. None of the other cities we're in right now have this program I'm aware of. We're in 5 states and multiple cities.
So this is the first one. Do you guys check with the city to see if there's any of that available?
We have, and we also, in a lot of cases, have checked like with the federal, where if you're close to like an airport, for example. I'm not sure if you're familiar with that, but there's some federal programs. We looked at a property that we were going to go under contract with it, but we decided not to. But it was closer to the airport in Atlanta, and in that case, the federal government, and of course, dealing with them sometimes can be an issue, but they'll give you like new roofs, new doors, new windows, some people said they even got new HVAC units. I'm like, that doesn't make any sense because it's noise control.
Is that due to the vibration or something?
Yeah, exactly. Yeah.
Wow.
So, and then there's other things. It does make sense to check. We got another property here in North Dallas that my partner, I don't know how he found it initially, but we got like $350,000 for HVAC units on a 255 door property.
Wow. What was the reason behind that?
It was a grant.
Oh.
So you can do some digging around and asking people, and it can. That's a big number. Yeah.
That's a very big number. So as far as the CapEx on this, we're right now, in a bridge loan ourselves, like you had mentioned earlier. And so we kind of know some of the process that you've gone through a little bit. So I'm curious to know, and I'm sure the people listening are interested in this too. What's the process that you have seen in working with the bridge lenders and trying to draw down that CapEx projection? So obviously they'll give you up to 100%. They'd like to see you draw it down in the first 12 months. Yeah. But what have been some of the things that you've seen through that process?
I'd say be prepared if you're going to get, and it's going to vary by, it's not just bridge lenders, by the way, too, right? It can be Fannie, Freddie, and things like that. But just a point of, I guess, caution is make sure you have working capital, contingency, whatever you want to call it, above and beyond what you think you need to close, just as a general statement. But if you're going to do this big rehab, which I know you're doing a big rehab too, Dan, and you have these contractors in there, they're not going to sit around and get paid, months down the road. They're just not. Yeah. So you need to typically pay that up front. The lender comes out their own sweet time to inspect it. They come back, yeah, looks good, doesn't, whatever it might be. And then it can be, and this is no joke, we have a property, another one in Dallas. It took us 5 months dealing with a lender. We were through everything except for this electrical work, and it's a big project. And so they said, we're not going to pay you all the other, well, they paid us half, let's say. We're not going to pay you even some of the other money you guys already spent and showed us. We don't know how big of the deal the electrical is going to be. It's like, well, you guys had your guys out here. You should know, you had the lender out here and the inspection guys determine it. So, you put in a draw request. Sometimes they won't let you do it once a month. So that's not uncommon where you can't put a draw request in every week for a lot of these lenders. So you have to stack them up so you can see where the time can really, can get to you. And if you don't have the money to start paying these, contractors up front, it's going to be a hard time getting the work done. You mentioned too, a good point too. Generally they want you to draw within 12 months. You can get extensions. with approval. And the other thing you can be aware of is that, you need to allocate the money you're going to spend for rehab that you think to the categories you think. So let's say I said, well, I'm going to just make the roof $100,000 more, but we might really use it in the parking lot. Well, a lot of lenders aren't going to give you that luxury of just changing the money around from one category to the other. We're going through another process right now in a deal. We have a bunch of money sitting there. We want to allocate some from one category to another. And I literally think it's been going on for 6 months. And I'm not even exaggerating.
Wow.
So,
man, you make me want to sit down here and take some notes now on this.
Well, I would say
do a webinar just on this topic.
Yeah. I mean, lenders are the biggest investor in the deal. People need to realize that as a general statement. And people are like, well, just go and complain and do this. They have a lot more clout. We had a property where the lender told us we couldn't use the current property management company, who we know and like and use, because the inspector guy ended up putting his foot through one of the floors somewhere. Not getting it hurt or anything. It's like, well, that was a function of the seller not putting any money in the property. It wasn't the property management company, but they literally told us you cannot use that property management company.
So you had to switch property management companies?
This particular one was before we bought it.
Oh, wow.
So we were going to use them. They managed several properties for us. And again, it wasn't their fault, but the lender said you can't use them because the property had some deferred maintenance. Like, well, it's not it's not like they would spend the money if they had the money to fix deferred maintenance. So just a lot of things a lender can control.
And you have to basically just say, yes, ma'am. Yes, sir. Move on.
That's right. That's
right. What would you say is the amount that would be a good amount to save or raise an additional amount for that operating reserve or whatever, for being able to pay for some of these CapEx expenses ahead of time as you're getting the draws, in the future?
So at a minimum, whether we even have rehab or not, we keep usually a full month's rent. So let's say your rent for all the properties, combined, all the units, combined was $80,000 as an example. At a minimum, we'll keep working capital of $80,000, whatever that one month's full rent is. And then if you have rehab, then we'll usually do more. And it depends how big the rehab is, because a lot of people probably listening to can realize even on a house, maybe you rehabbed, you spent more money than you thought you were going to spend. It took longer than you thought it was going to take. So it can happen. If you can do, 10%, I think that's pretty good for most projects.
That's above and beyond. CapEx amount, right?
Yeah. Well, the CapEx amount, I would probably do a little more. 10% of the raise.
Okay.
So yeah, the CapEx amount, yeah, even the lender is going to usually do 125%.
125% of
what you think the rehab is. If you said the rehab is $1 million, and you're the lender, you'd say, that's great, Mark, $1 million, but you're going to put 1.25 away for rehab because you couldn't go above and beyond the 1 million.
So the lender will recommend that ahead of time.
They'll usually enforce it.
Yeah. So is there any reason why, or what? Let's say you got to that 1.25 on that particular example, and you needed to get to 1.5. Do they ever change it afterwards and give you more? Have you ever seen that?
Give you more money, even before you close?
Then the original CapEx projection of like you said, you were projecting $1 million. They said 1.25, and then you actually went to 1.3 or 4 or 5. Would they give you more, or do they stick strict to the 1.25?
After the close, yeah, I've never seen anyone do that.
So once they close, that's it.
Yeah. Yeah. I mean, I suppose you could probably go try to get it, but in general, like a bridge lender might, but it's going to be really expensive money, and they'll charge you probably $30,000 to $50,000 just to change, to do a one-pager change to your loan. Well, they will.
One-page change, yeah.
Yeah.
Okay, so that's the bridge loans. How did you structure this deal? Well, first, let's talk about. How did you structure the deal with investors?
Yeah, this one was a 70-30 split, so 70% to investors, 30 to the sponsor team, with a 8% preferred return.
Mm-hmm.
So preferred return, I know a lot of people don't, simply means that the investors will receive the first 8% before the sponsors receive a dime. And then anything above the 8% will be split 70% to the investor and 30% to the sponsors.
What kind of fees were in this one?
We had a 2% acquisition fee, so it's a one-time
Pretty standard.
fee based on the purchase price. And then we have a 1.5% asset management fee, and we take the asset management fee based on the monthly total income collected, so include your revenue plus other income. And that's it. No waterfall or anything like that.
No disposition fee or anything?
No refi fee, no disposition fee.
Okay, so straight up 2% acquisition fee, 1.5% asset management, and then 8% preferred return, and then 70/30.
Correct.
Okay, that's pretty straightforward. What I've been seeing too. So it's always nice to kind of see how other people structure it and various things like that. So the amount of money that you had to raise on this particular project was how much?
We raised probably let me see, I think it was close to 3.
Let's say if you're right at that times, you got 85% loan to value on this one, or 80%?
The one I said was a different property there. I don't remember exactly if we got 85 on this. We might not have gotten quite 85 on this, but we just did a loan, 85% with 100% rehab.
Yeah. Okay. So yes, you're probably right at that 3 million mark. How long did it take you to raise the 3 million?
This one went pretty quick. My guess is, said and done, you money in, because, people commit and, or preliminary commit. People say, I'll raise $8 million or whatever on a webinar. Well, did everyone send in their money? I mean, what do you mean? I mean, I've seen that before too. And then push comes to shove and people don't send their money in, or they're,
Well, let's ask you it in a different way. So, because I would answer it different ways too, like you're saying. So, how long did it take you to get fully committed for the full 3 million?
My guess, we were probably fully committed in about 3 weeks.
Okay.
Usually what happens is a huge percentage of it gets fully committed, really quickly, and then you'll have those stragglers and things like that. So. Yeah. But
we had that happen on one of our projects too, where we got fully committed within about 4 to 5 days.
Yeah.
And about a week before closing, one of our big investors backed out. He was bringing about 10% of the total raise.
Yeah.
So we had to raise that in the last week.
No, that can happen, and it's unfortunate. And just because people say, "Hey, I'm interested," until the money's in the bank, it's a different story.
Yeah, that's why it's first come, first serve. So
that's right.
First person that hits the count, that's the one that's in the deal.
That's right.
So during your due diligence process, did you find anything kind of unusual or abnormal on this property?
We didn't on this one. I think the interiors probably were a little better shape than we anticipated, frankly, to have that many. I think at the time they were saying they're calling them down units. Well, some of them didn't require a lot of work. But we already knew about the roof and the parking lot, HVAC units and things like that. And that's just kind of a point there too, that anything you can see ahead of time, you better not be going back to a seller and saying, "Oh, I want a credit now for, we know someone literally that a broker that I know, someone was buying a property, pretty expensive property, and they wanted to get a credit to get it painted. Well, you mean to tell me you couldn't tell that it needed to be painted before you went or LOI or a contract?
That's a pretty standard thing to be able to take a look at ahead of time.
So make sure, now if it's right, we have a deal right now that plumbing has a plumbing issue, so we're getting $100,000 credit on the plumbing. That's legit. Actually part of it's collapsed under one building. You would never know it. What's that?
Is it underground?
Yes.
Okay. The plumbing is, obviously. That's why it's collapsing.
Yeah. So it's but that's something that is considered probably legitimate, or foundation or things like that. But things you can see ahead of time, don't go back to the seller, in my opinion, and ask for credits for it.
Yeah. At what point did you actually tour this property? Was it during the due diligence phase, or did you see it before you got it under contract?
Before.
Or during LOI, or at what point?
Even before LOI.
Okay.
Actually, my partner that was in town, and he was there looking at some other properties that we already owned, and the broker told him about this deal, and he went by it and saw it. And so we had kind of an inside track on it.
That's good. That's great. Well, what about the area? What did you guys kind of already know a little bit about where it was located and making sure it was on the right side of the tracks and all that kind of stuff?
We did, and we, already being there. I'm trying to think. We had 3 or 4 deals before this one
Okay.
there.
So you kind of already knew the market.
We do, and we have a property management company there that's just literally phenomenal. Probably the best property management company I've ever worked with by far. And all I even do now, if it's a property there, ask him. He's about 95%. Nope, don't pursue it, and about 5%. Yeah, I should look at it. He's either managed it before, or he knows it, or he owned it before because they own properties too. So having someone local like that, people think they have to go jump on a plane to look at a property all the time, and you do at some point. But initially, having someone on the boots on the ground, so to speak, in an area with someone you can trust to give you feedback ahead of time will save you a lot of time.
Mm-hmm. Yeah. How many rounds of offers did you go through during the bidding process to get to the signed LOI stage?
I think just 2. Remember?
Okay.
Yeah, it wasn't. The seller was a reasonable seller. Like I said, I think original builder probably has. I don't think he owed a penny on it. So it's like anything he's making off it. So it was not a difficult process. We've had difficult processes, even just one recently as of last week, where early access agreement. Most people that know it means you get to go in before a contract and go look at units and we do our full due diligence ahead of time. Well, this particular seller, no joke, said that you can't get any units during your early access agreement, which why would we have early access? We can just drive by the property then. Then he agreed to 10%, and we found some stuff in the 10%, and we told them we're not moving forward unless we can look at all the, because we have hard money on that. So if we go to contract, we put hard money down.
Yeah.
So it's just kind of a side note there. Put hard money down, I would do an early access agreement, make sure that the early access agreement allows you to get in all units and ahead of time.
Yeah, that's definitely a good point to make sure that, especially when you're putting up hard money, that you have in the agreement that you have access to all of the units, not just a percentage of them or whatever.
He literally wouldn't even let us do the lease audit. And then he wanted to kick the plumber off when he let the plumber. So it's just an inexperienced seller. I mean, even the brokers were having a real hard time with him, but
that wasn't this deal though, was it?
No.
Okay. That was a different one.
This one just came up literally. I'm talking that's been less than a week.
Oh, okay.
So,
did you put any hard money up on this deal?
No.
So this was a straight, just, earnest money, 30-day due diligence, and that was it?
Yes.
How much earnest money did you have to put down?
1%.
Okay. So
that's pretty standard, but in some markets, frankly, you're going to have to probably go a little higher than that to be. When you're looking at doing your letter of intent, you want to see something that, if everything is equal, what's going to make you stand out? Hard money always will make you stand out above the rest if you want to do that. Maybe a shorter due diligence period, 21 days versus 30, whatever it might be. We've done a 14-day once. If you have your teams, you can do it. And then, putting up more earnest money up front and or putting up earnest money after the 30-day due diligence period. And that'll make it more attractive to most sellers.
And as far as the financing is concerned, do you go direct with these bridge lenders and then in Fannie and Freddie, or do you have a broker that you go through?
A broker. Yeah. And you don't have to. I would say I like going through a mortgage broker because they do all the work as far as finding the best deals, things like that. It's just time I don't want to spend doing that. You do pay a fee for it, so they don't work for free.
Which is negotiable.
People definitely, without, especially after you start doing more business with them. But if you're new to multifamily, I think you're crazy going just to a lender, frankly. I think you need somebody that understands this, can explain it to you in detail. And you can spend all the time in the world trying to find all the different options you want to, and you can probably do that. But these mortgage brokers and we have contacts now with all these guys too. But reality is they save us time by doing it.
Well, and I know sometimes even with Fannie and Freddie, you can go direct with some of the DUS lenders as well, which act as brokers in other areas for bridge and stuff like that, like Arbor and CBRE and Eastern Union and Walker Dunlap and all of those.
Yeah. If you go direct through a DUS lender, the only difference will be is that they're limited on the exceptions. So let's say, for example, I know you got a 60-year IO on one of your deals, right? You did, Dan.
Yep.
You can't get that with DUS lender through Fannie. If you do a DUS lender for Fannie and Freddie, their exceptions are limited what they can do.
So it's better to go through a broker?
No, I'm just saying if you go through that would apply no matter what. A DUS lender basically would mean that they can actually underwrite the deal and everything directly. Arbor can, right, and not have to go Fannie and Freddie, and they lock in. The advantage is you lock in, and it shouldn't be retrading on you. Whereas if there's plus and minuses. If you went through a broker and then they go to Fannie or Freddie, Fannie and Freddie 2 weeks before closing, 3 days before closing, whatever, can change terms if they want to.
Have you ever had that happen with Fannie or Freddie?
Yes. Mm-hmm.
Yeah.
One, for the positive, they gave us $371,000 extra proceeds. I'm not sure why, but they did. And a couple times for the negative. So,
what about a bridge lender? Have you seen them do that too?
This is my general statement, and this isn't to criticize bridge lenders because we do a lot of bridge loans, but bridge lenders will be more apt to screw you than other lenders. They just are.
Yeah. Do you feel comfortable mentioning any good bridge lenders that you've worked with?
I've only used them once. I'm going to be using them again. Bancorp, and it's recent, so it's been the last 6 months. But
we used them as well on our deal in Greenville.
Positive or no?
Still out.
Yeah. Well, let me talk about before closing, because that's the part that's most relevant, because it's only been a few months, but they had some legitimate reasons to retrade on us, and they didn't. They honored everything that they told us ahead of time, and I don't find that with a lot of bridge lenders, frankly. But I have one scenario with it. We have another one we're going to do. So to really recommend them based off one experience, I probably wouldn't do that. But
they didn't retrade on me either, which I was prepared for it.
Oh, really? Okay, so that's good, especially for a bridge lender.
Yep, and I'm actually a loan guarantor on another project that's going through Bancorp as well.
Okay.
So they're used to me now. Once you go with them once, they're usually pretty easy to get another one.
Yeah. Oh, yeah. So they could be good for sure.
Well, and one of the things that from a loan guarantor standpoint that I didn't realize with Freddie Mac is because we also have another project that we did through Freddie Mac, and it required us to prove my own liquidity for the project, and any accounts that had my wife's name on it, they cut in half my liquidity.
Yeah, because she's not the KP. Yeah.
That's the that was with Freddie. Now with Bancorp, I just send them a statement from my bank showing them my liquidity, and they didn't say another word after that.
Okay. Yeah. The one other point about liquidity, just in you're aware of it, but people maybe not be aware of it. Let's say you have a deal and you put $200,000 out as earnest money and things like that. The lender will not count that as liquidity, even though it's in the deal. It's, you could say, hey, it's liquid, right? Well, no, it's tied up in a deal. So any earnest money you put in, some sponsors might have 2 deals at one time with the money out. They won't count that as liquidity.
Yeah. But one thing that I have been told, which I have not used it yet, and maybe you have some other insight on this, is if you have equity built up into your house, you can put a HELOC on your house for that equity that you have in there, and then pull that out of you can't use that just on the house as liquidity, but you have to pull it out of your HELOC and put it on in an account. And as long as you have that in your account, you can show a snapshot of it. Like Freddie Mac required a month-end statement. So you just put it in there at the end of the month to make sure it's on their month-end statement. It's good. The only thing it does is it reduces your net worth by the amount that you pull out.
Right. That's right. That's
exactly. As long as you have a high enough net worth, it shouldn't really affect it that much. But
right.
You definitely need to keep that into consideration. Yeah. Have you ever seen that done? Have you ever done it yourself?
I have seen that done. I have not done it.
Yeah. Well, I have a HELOC on my house as of Thursday this week. It's actually tomorrow.
Oh, wow. Okay.
But I'm not planning on using it unless I need it. So
yeah, sure. No, I mean I have a line of credit too. That helps in situations like that too. That you can having that available when you need it and put money down on deals, I think that definitely can be helpful.
Because lines of credit is liquidity. As long
Yeah,
as
and
you can.
it's just revolving, right? You kind of
Yeah.
use it when you need it, and you don't pay on it unless you're using it and things like that. So it's good.
Yeah, that's the nice thing about it is if you're not using it, you're not paying for it. And then if you need it, you can use it for a couple of days to however long you
Yeah,
need usually, and you put it back on. So
that's
especially for
right.
this kind of purpose for like earnest money or, the hard money or whatever, it's and application fees. It's nice to have a little bit extra there just in case, because you even have to kind of balance it too. And I'm sure you're probably been in this situation or you kind of have to balance this is each deal kind of resets with as far as like the net worth and the liquidity is concerned. And so even though on one deal you might need 10 million net worth and 1 million liquidity, the next deal is totally different and separate from that. So if you need
Yeah.
another 10 million and 1 million, you can still use your same 10 million and 1 million for that deal too. So it doesn't matter how many, but you also have to make sure that you maintain that net worth and liquidity throughout the entire hold period of that loan with that lender, and they also will come back and check you along the way too.
Yeah, usually at the end of each year they want a financial statement.
Yeah. So so you haven't seen them checking it throughout the year. They just want end of the year, make sure you have, liquidity and net worth.
I've never had it checked throughout the year.
Yeah. Okay. Unless there was an issue with the loan or something. I can't imagine them wanting to spend that time doing that. As long as
Right.
now, here's the other question. What if you get to the end of the year and your net worth and liquidity is a little bit less than what they would require?
I'm pretty sure I have. I've never had an issue with it.
Okay.
I'm confident I have. I mean, you think about it. I mean, like I said, any money out, earnest money. I've had money out, 3 or 4 deals at a time. So I'm pretty confident at some point in time, I've been below what it was, and I've never had an issue with
Yeah.
it. I'm not saying
What
you
are they
can't.
going to do? Like, why would they call the note if you're paying your bills,
Yeah, that's exactly right. That's a good point too. There are a lot of things in those documents that theoretically could allow the lender to call the note, but they don't really want the property back, at least in this day and age. They may at some point, but they don't right now, generally speaking. So,
Yeah.
yeah.
So what's the plan for refinancing this country view? Are you going to be doing that now, or are you going to be waiting another 12 months or?
No, we're doing it now. We'll close at the latest February. So we're real far along. We already have everything. We've already done our docs, everything.
So what's the refinance out of that? When you said you're getting 100% of the equity that you got into it, right? So you're
We'll get over 100% of the equity. And in fact, the lender probably is going to give us, if we wanted it, we probably don't because you want to be a little bit cautious, but will give us even more than we probably are going to take.
Yeah. So that's about what, 16 million valuation?
No, it's actually more.
Because you're going to probably go less LTV. You're probably at what, 70% proceed?
Yeah. So I think it's I don't remember the exactly, but it's more than 16. I know that.
Yeah. Okay. Well, good. Well, that's awesome. And a couple of follow-up or wrap-up questions I'm going to have here. I have kind of three of kind of 2.5, I guess. Well, I already know the answer to the last question about whether or not you're a part-time investor or not. So I know you're a full-time investor, so I don't need to answer that question. But first question is, what did you find easy during this process of acquiring a country view that you might have thought would have been a little bit harder?
So I had done a number of deals before that, so the process was pretty smooth. I would say the pilot program, which was our first time doing it, was involved with the city. So your first time doing that, you pay a little bit for it too. And then the lender,
you have a outside consulting company that does most of that stuff, don't you?
well, they do some of the evaluation, but the application, also like that, we do that ourselves.
Wow.
We used our property management company as well to help with a lot of stuff like projections and things like that. So that was quite involved. And then the way the title and stuff is because of the abatement. Then the lender had an issue with the way the city was part of almost kind of considered part of the deal. That's a way to get through that. So that one, reality, every deal kind of has a little, one or two or maybe more things that kind of like, oh my goodness. That one is pretty smooth with the exception of the pilot program going through that process.
Mm-hmm.
It's a lot of work.
Excuse me. And so on the opposite of that would be, what did you find that was going to be harder than expected? But I guess that was probably the harder part that you didn't expect.
It was. Yeah.
Well, I have no further questions regarding this country view. The 321 doors sounds like it's a phenomenal deal. Obviously, being able to pull out 100% of your equity 13 months in is a phenomenal deal, and I'm sure your investors are excited about that. And hopefully they'll be taking those returns and putting them back into future deals that you're going to be putting together in 2019.
Yeah, I hope so too. And I would say that it's a little bit of an anomaly. So people that are listening go, man, 13 months is fast.
Yeah.
We did one recently for a little over 2 years, and that's pretty fast too. But I would definitely say this is one of those projects where, virtually everything just lined up, and everything that could go right went right, and even went better than we thought. So I don't want everyone to necessarily think that that's the norm. But reality is that at some point in time, you increase the value, you can pull the money out, refi, supplemental loans, sell it, whatever, and make good money off it for sure.
Now, did your projections, as far as like your underwriting, did it include the refi?
Yes.
Okay. At what point did you originally project it coming in?
We were 2 years, and I think we have 3 years total. We could have held the bridge loan for.
Yeah. Wow. That's a phenomenal deal, man. I wish I would have been invested in that one.
Yeah, well, it's easy to look back on them too. I wish I would have put every dime I had in that one.
Yeah, that one would definitely have been a nice one to be able to pull out. So,
yeah.
Well, do you have any way for people to contact you if they have any further questions about this deal or any other future deals you're putting together, or maybe to reach out to you if they're interested in possibly investing with you?
Yeah, probably best just my website's Think, so THINK multifamily.com, and my email is Mark MARK at thinkmultifamily.com.
Great. Well, that's great to have a good insight into this 321 door property there in Memphis, Tennessee. Thanks for joining us here today, Mark. Wish you the very best, and thanks again. Look forward to having you on a future episode to talk about another one of your deals coming up too.
All right. Thanks, Dan. Appreciate it.
All right, you too. Bye-bye.
Bye.